Let's talk about non-stress test banks or institute, not banks, but it's more trust companies, right?
Yeah.
So what's a stress test today? Like, what's it?
It's brutal. No, I'm just kidding. It's 2 points above the rate, right? So whatever your interest rate is that you're getting on the mortgage, they're adding 2 points to it. So we still have credit union money that is available that is non-stress tested, right? So, and that's the beautiful thing about working with a mortgage broker right now when you end up needing different options is that, you know what, if someone's cash flow pinched, they need a little bit extra approval, you might be paying a marginally higher interest rate at 1 point or 1.5 points, but then you might get an approval that's maybe $50,000, $75,000, $100,000 or $150,000 higher than another one, right? And I think it's good for us to understand that, you know, rates are where they are, but everything that goes up goes down and everything that goes down goes up, right? So there will be a moment in time when rates go down. So if this is an opportunity for someone to get into the market with an extended AM or no stress test, well, when rates change, that might be an opportunity for them to change the mortgage as well too.
Cool. So what else have you seen that's creative to get people entering the market? What are you thinking?
Well, you know what's come back too is just the simple stuff like RSP loans. You know what I mean? Like RSP loans were something we used to talk about a lot, right? So, you put money into an RSP, you get tax back. Does everybody know about that? If you don't, reach out to me after. We'll do a webinar. Okay. But what ends up happening here? So if someone needs a little bit extra money to get that down payment to 20%, because as soon as you get to 20%, a 30-year AM opens up. It's a little bit easier to qualify. Maybe a 35-year AM opens up. And if someone's sitting at the 10, 15% down payment and they get an RSP loan, the cost to keep the RSP loan, right, in their debt service calculation, because there'd be a loan payment for that, is in most times cheaper, so they can amortize out and get more mortgage money. So these are some of those creative strategies that we look at. I think, your clients today are bloody resilient, and a lot of the people that we see, and I love what you said at the beginning, they're not worried about the interest rates, people that are getting into the market right now. They're resilient. They're looking at it. They can see that they can afford it. We're running numbers on it. I know James says well too, on a pre-approval, probably every 30 days, because rates are changing, we're giving them an updated amount. Hey, if you don't buy within 120 days, your pre-approval might be reduced. Hey, guess what? Now your pre-approval is extended for another 120 days because the fixed rates went down a little bit. You get a little bit more money. People are good with that right now, I find.
What's 6 months? Because now let's think now, because now inflation's down to 3.3. Okay, they're getting closer. They might do another pause. The market might heat up. US are talking maybe sometime in 2024. I don't know where they're going to talk about going back the other way here. But is 6 month an option, or
I'll tell you what.
How high is 6 month right now? And is it worth look, people go into the private market, commercial people have used private to get, to stabilize things. Even though the 6 month is a high rate, why would people look at it just to kind of stabilize things and be able to because you're never going to time the market. And I'm just thinking, is going 6 months at a time the best way to time the market?
I think if you've got, it's a great question, because we've seen some great rate incentives for 6 months, right? There's a lot, if you look on these sites like Rate Hub, they're called rate aggregators. So you end up looking at them, they're really super cheap rates. There's really good 6 month term, but to me, that's just kicking the can down the road for 6 months. And then you're still kind of in that same situation. If you have excess cash flow, if you're in a good situation, sure, play the volatility there and you can have the risk. But what we're selling most of right now, back to basic, listen, everybody was saying variable is better than fixed for the longest time. When times change, sometimes you need to change your advice, right? And right now, the 5-year fixed rate, we've sold more 5-year fixed rates now in the past 60 days than ever before. And this is something that your clients need to realize, and I want you guys to realize too. When people say rates are going to go down, that's the variable rate.
Yeah.
Currently, we are in an inversion, which means that fixed rates are lower than variable. That's not normal. So when that rate goes down, that variable rate that's almost at 7% today, when it goes down, do you think it's going to go down way below the fixed? It's got to go below the fixed, right, to be in a normal market again. So if you're getting a fixed mortgage rate at 5 years at 5%, that variable's got to go to 7 to 6 to 5 to 4. That's a big fucking drop.
Yeah.
Okay. At a quarter point or a half point in time.
Yeah.
So when everybody's saying, I'm waiting for rates to drop, I'm waiting for rates to drop, that fixed rate is not the one that's going to be going down 2-3 points. It's the variable. So educate your clients on that. It's really tough for us to educate because everybody's in that wait. Take a 5-year, set it and forget it. Anybody who took a 5-year mortgage in 2022, right, or in 2020 right now, you know what they're saying? Yeah, they're at the keg. They're at the keg having Billy Miner pies every goddamn weekend because they don't care.
They get a booth at the keg.
Yeah, they got VIP. They got bottle service at the keg, right? So you know what? I don't think it's terrible. As long as it's with your goals, with your client, you should be buying a house for minimum 5 years. I know people break their mortgages, but most banks have blend, extend, can move. A 5-year term right now is sleep insurance. Sleep insurance right now.
Yeah, cool. That's good. Well, just a lot of people are trying to time it. You'll never be able to time it. And
I've been so wrong these past 2 years, so I'm just yeah.
The only thing is buy long-term bonds because they're going to be the one that they'll be huge. They'll have huge value in the next year or two.
True. Yeah.
That's totally. Without question, right? Totally. That's going to be a huge asset class.
Yeah.
So very cool. Anything else? Any questions? Guys, this is where you gotta get people's mindset. If there's, everybody tells me my guys are sitting, waiting, whatever. I don't know what they're waiting for. Okay, because look, if it pauses another time and we saw what we did, or if it drops a quarter point, look out. Look out for prices. Okay,
that's true.
Cool. Thanks, Brian. Thank you. Okay.